If you invested $10,000 30 years ago in an average, actively managed fund instead of a simple index fund, you would have about $26,000 less today. Not because the market did badly, not because you made the wrong bets, just because of fees. Fees you probably never noticed because they were never shown to you as a dollar amount. They were just quietly subtracted from your returns, year after year, for 3 decades. That is what this video is about. Not market timing, not stock picking, just the single most consequential choice most new investors get wrong: choosing the right type of fund and knowing which account to put it in. Before we get into the differences, I want to establish something most comparison videos skip over, because it is actually the most important thing to understand first. Index funds and ETFs are far more similar than they are different. Both are passive investment vehicles. That means neither is trying to beat the market. They are designed to match it by holding the same basket of stocks as a market index like the S&P 500. Neither has a fund manager in an office making decisions about which companies to buy or sell. Neither carries the costs that come with that. Think of them like this: an index fund and an ETF, both tracking the S&P 500, are like two different ways of buying the same car. Same engine, same destination. The only thing that changes is the purchase process. And that simplicity is what makes them powerful. Let me show you why. In 2025, 79% of professional, actively managed large-cap fund managers, people paid millions of dollars to research and pick the best stocks, underperformed a simple passive index fund. This is from the SPIVA scorecard, published annually by S&P Dow Jones Indices. Not one bad year. Over 20 years, 92% of actively managed domestic funds underperformed their benchmark. 9 out of 10 professional stock pickers over a 20-year period could not beat the index, which means the real debate is not index fund versus ETF. That is a technical distinction about how you buy the fund. The real debate, the one that has been settled by 20 years of data, is passive versus active. And passive wins, by a lot, for most people, most of the time. Everything else in this video is important detail, but that is the foundation. Now that we have established what they share, here are the 5 real differences, and I will be clear about which ones actually affect your money and which are mostly fine print. Difference 1. How you buy and sell them. An ETF trades on a stock exchange like a share of Apple or Tesla. You open a brokerage account, type in a ticker symbol, VOO or VTI, and buy it anytime the market is open. The price changes throughout the day. An index mutual fund works differently. You buy it directly from the fund company, Vanguard, Fidelity, Schwab. Orders are processed once per day at market close at what is called the net asset value, or NAV. For a long-term investor who is not planning to react to intraday price movements, which, frankly, you should not be, this difference is completely irrelevant. Whether you bought at 9:30 in the morning or 4 in the afternoon will not matter in 20 years. Difference 2. Tax efficiency. This one genuinely matters, especially if you are investing in a regular taxable brokerage account. When another investor wants to exit an index mutual fund, the fund manager has to sell holdings to generate the cash to pay them out. If those holdings have gained in value, that creates a taxable capital gains event, which gets passed to every investor still in the fund, including you. Even if you never sold a single share yourself, you could owe taxes on gains you never actually received in a year you never made a single transaction. ETFs sidestep this almost entirely. When an ETF investor exits, they sell their shares to another investor on the stock exchange. The fund itself never has to sell its holdings. Vanguard's VOO has never distributed a capital gain since it launched. Not once. Here is the important caveat. If your money is inside a 401k or an IRA, this difference does not matter at all. In a tax-advantaged account, gains are sheltered from tax regardless of the fund structure. The tax efficiency advantage of ETFs only becomes real in a taxable brokerage account. Difference 3. Minimum investment. This gap has mostly closed in 2026. ETFs have no minimum. Buy 1 share, or as little as $1 through fractional shares at Fidelity, Schwab, or most modern brokerages. Index mutual funds from Fidelity and Schwab now have $0 minimums. Vanguard still requires up to $3,000 for some of its mutual funds. If you are starting with a small amount and want to get in immediately, ETFs give you slightly more flexibility. But for anyone who can meet the minimums, this difference is minor. Difference 4. Automatic investing. This is where index mutual funds win, and it is a practical win for people who want to completely automate their finances. With an index fund, you can set up a recurring purchase of exactly $77 a week, or any precise dollar amount, on a fixed schedule. The fund processes it automatically at end-of-day pricing. No thinking, no logging in, no decisions. With ETFs, most brokerages still require you to buy in whole shares. If VOO costs $480 per share, a $77 recurring transfer cannot buy a full share. Some brokerages now support fractional ETF auto-investing, but it is not universal. If your goal is to set up a recurring investment and never think about it again, index funds are currently simpler. If your brokerage supports fractional ETF auto-investing, the difference disappears. Difference 5. Fees. Both are extraordinarily cheap. VOO and VTI both charge 0.03%, that is $3 per year on $10,000. Fidelity's Zero Index Fund charges literally 0%. These are rounding error differences between the two categories. The fee conversation only becomes urgent when you compare either of them to the average actively managed fund, which charges 0.64% per year. That is where the damage happens. And that is exactly what we are going to show you the math on right now. Let me show you exactly what fee drag looks like over time, because this is the number that should permanently change how you think about fund selection. Take $10,000. Invest it today. Leave it for 30 years at the S&P 500's long-term average return of 10% per year. In an index fund or ETF like VOO at 0.03% annual fees, you end up with approximately $174,000. Total fees paid over those 30 years? About $209. Now take the same $10,000, same 30 years, same 10% market return. But this time you are in the average actively managed mutual fund, charging 0.64% per year. You end up with approximately $148,000, $26,000 less, and that is before accounting for the fact that 79% of those active funds underperformed the index anyway. You paid more for worse results. And if you left that $10,000 sitting in a regular savings account, earning the national average of 0.38%, after 30 years you have $11,181, barely more than you started with, while 3 decades of inflation quietly eroded what it could buy. Same money, same 30 years, 3 completely different outcomes. The only variable is where you put it. The question is not really index fund versus ETF. The question is passive versus active. And the data on that question has been settled for 20 years. Now let me get specific. When you are ready to start, here are the 4 funds you will most likely encounter, and what you actually need to know about each one. VOO, the Vanguard S&P 500 ETF. This tracks the 500 largest companies in the United States. It charges 0.03%. As of 2026, it holds nearly $1 trillion in assets, making it the largest ETF in the world. For most beginners who are not sure where to start, VOO is the default reasonable answer. VTI, the Vanguard Total Stock Market ETF. This tracks the entire U.S. stock market, about 3,500 companies, from large caps down to small. Same fee, 0.03%. It is 99% correlated with VOO because large companies dominate both funds. Pick VTI if you want the broadest possible U.S. market exposure in a single fund. SPY, the SPDRS and P500 ETF. Tracks the same index as VOO. Charges 0.09%, roughly 3 times the fee. It is the most traded ETF in the world, and it was the first ever created back in 1993. It is built for institutional traders who need deep liquidity for options trading. For a long-term investor just building wealth, there is no reason to pay SPY's higher fee when VOO and IVV track the identical index at a third of the cost. If your money is in a 401k or an IRA, here are the index mutual fund equivalents. Fidelity Zero Total Market at 0% expense ratio. Schwab S&P 500 Index Fund at 0.02%. And Vanguard 500 Index Fund, VFIAX, at 0.04%. All three track the same market. All three are excellent. So which one should you actually use? Here is the honest answer, without the usual hedging. If you are investing inside a 401k or an IRA, use an index fund. The tax efficiency advantage of ETFs disappears completely in a tax-advantaged account. Index mutual funds make automatic investing of exact dollar amounts simpler. And most 401k platforms only offer mutual funds anyway. If you are investing in a regular taxable brokerage account, use an ETF VOO or VTI. The tax efficiency advantage genuinely matters in a taxable account, and there are no minimums to worry about. If you are starting with less than $1,000, use an ETF. Start with $1 fractional, no barrier to entry. If you want to fully automate a fixed amount every week without thinking about it, use an index fund. Set it up once and let it run. And if you are still agonizing between the two, here is the most honest thing I can tell you. The difference between an index fund and an ETF is a rounding error compared to the cost of waiting. The most important decision is starting. The second most important is staying invested when the market drops. The ETF versus index fund question comes a distant third. Let me bring it all together. Index funds and ETFs both do the same job. Low cost, passive exposure to a market index. Dramatically better than paying a professional to underperform it. The 5 real differences are how you trade them: tax efficiency, minimums, automatic investing ease, and fees. Of those 5, 2 genuinely change the answer. Tax efficiency favors ETFs in taxable accounts, and auto-investing ease favors index funds in retirement accounts. The fee difference between VOO's 0.03% and a good index fund's 0 or 2 basis points is noise. The fee difference between either of those and an active fund's 0.64% is $26,000 over 30 years. Pick either. Keep the expense ratio below 0.1%. Stay invested through the dips. That is the entire strategy. The next question after this is usually, how do I actually build a portfolio? How much goes into each fund? What's the right allocation for my timeline? Every video is a new chapter. Like, subscribe, and hit the bell icon to stay connected with the ledger.